Hi guys, welcome back to the Daily Forex. In today's video, I'm going to share with you guys a very powerful strategy that you can use to grow your small account into a big account. I've used this strategy to grow my small account and I've made a great amount of profit using the same strategy. So I want you guys to watch this video to the very end so that you can understand how to use this strategy perfectly and grow your account and make profit using the same strategy on boom and crash indices. Alright, so let's get started. This strategy is very accurate, so watch and understand every bit of what I'm about to teach you guys. You see, most traders show you their big numbers but won't tell you how to go about it. That's why I take my time to teach you guys so you can make profits like I do. But first, I'm going to explain how the strategy works before I show you guys the setting I use for the strategy. So I use just two indicators for this strategy, which is the moving average of oscillator and the stochastic oscillator for this strategy, which I use to make profit on crash and boom. So I'm going to start with crash 500 index, right? So as you can see, the indicators are already on the chart. So I'm going to show the settings later on the video for the indicator which I use, right? So I want you guys to pay a close attention on what I'm about to show you guys right now. So right here, these black and red lines are the stochastic oscillator, while this blue line on the middle and these levels, these three levels here, are the moving averages of oscillator, and this one right here, the black and the red, is the stochastic oscillator. Okay, so the stochastic oscillator and the moving averages of oscillator are very important with this strategy, as we're going to use the strategy to detect when the spike is going to happen. Okay, so we're only taking the candlesticks from the market. We're trading the bullish pattern, we're not trading the bearish. We're trading the candlesticks, we're collecting the sticks, we're not trading the spikes, right? So what we do is to take a buy only. We're not taking the sell, we're only taking the buy. Okay, we're taking the buy from the downtrend of the moving averages of oscillator. We take a buy after the spike has occurred. Okay, and we're using this on the fourth zoom level, right? So the first thing you want to do is to zoom out. Okay, when you zoom out, you start counting the levels. You start 1, 2, 3 and 4. Okay, then you screw the chart to the very end. Okay, you screw the chart, then you zoom out 1 again. Okay, until this level 67 right here is at the middle of the moving averages of oscillator. Take a look at it. This level 67 is going to be at the middle of the moving averages of oscillator at this point right here. So like I said, you zoom out, then when you zoom out, you count 1 to 4, you zoom in 1 to 4. Okay, you zoom in 4 times, then you zoom out again until this line at the middle, which is the 67.99, is between the upper moving average of oscillator and the lower moving average of oscillator. So it has to be between the middle right here. This is the upper moving average of oscillator and this is the downward moving average of oscillator, right? So like I said, so now how do you take candlesticks on those markets? How do you do it, and how do you avoid spike? Let me show you. So what you do is to wait after the spike right here. You can see there's a spike here and there's a spike here. So the spike has to come inside the lower part of the moving average of oscillator. So the moving average of oscillator is going to be inside the stochastic oscillator. You can see the trend line. This blue line right here is the trend line and it's inside the stochastic oscillator, which is this black and red lines. So these lines you are seeing here, which is the blue line, is the moving average of oscillator. It has to be in between the stochastic oscillator. You need to be inside. In a downtrend, that's when you place a buy after the spike. A spike also going to come inside. So when you wait after the spike, then you take your candlesticks, right? Then when you see that the moving average of oscillator has crossed the stochastic oscillator, you exit. That's going to be your exit point. Your entry point is going to be after the spike inside the stochastic oscillator. When the moving averages of oscillator is inside the stochastic oscillator at the down point, you take a buy. then you exit when it crossed the stochastic oscillator. Then if when it's going in an uptrend, you place a buy again, right? So like you see right here, this is a down point after the spike, and the reason I said you need to exit when it has crossed the stochastic oscillator, which is the black line, is because this line right here, which is stochastic oscillator, if it did not cross above this level of 80, take a look at it. This is the level of 80. If you trace it at this point, take a look at it. This is 80, the upper line, the upper trend right here of the stochastic oscillator. If it did not cross above, you can't place another buy immediately. Okay, so that's when you have to exit when it has crossed this black line. Then you wait after the spike. If it cross above the level of 80, immediately you place a buy after the spike. Okay, like you see here at this point, after the spike inside the moving average of oscillator, okay, to get this is the spike, you place a buy. Then you exit when it had crossed the stochastic oscillator. Okay, then when it crosses stochastic oscillator in an uptrend again, you place a buy. Then when the stochastic oscillator, the black line, when it crossed each other at the overbought level, take a look at it. This point right here, which is about level 98, is the overbought. So when they cross each other, know that a spike is going to come through. A spike is going to appear, although you won't see a signal for the spike. So what you do is to wait for few candle ticks, for like 3 candle ticks before exiting at that point, before the spike will come. The spike may come after 5 or 4 candle ticks, right? You can see the space gapping. Let's say at this point right here, you place a buy, then you took 1 2 3 4 5 6 candle ticks. If you trace it up, you can see the point when they crossed. You can see this is the point right here. They crossed the black and the red. You can see the point where they meet each other at the top of the overbought level. This is the point right here. Okay, if you trace it backwards, you can see that you gotten 6 candle ticks as profit on the market. Then if you see the remaining space right here, you can see about 2 candle ticks before the spikes. Okay, and when the spike is going to come, the stochastic oscillator is going to drop down, which is the trend. It's going to come down immediately. There's a spike. Take a look at it. This is the spike. Although the spike is small spike, but it doesn't mean the spike might be big. So you can't tell if the spike is going to be small or if the spike is going to be big. The spike is always a spike, right? So we took a buy at this point in the downward trend of the moving average of oscillator inside the stochastic oscillator trend, the downward trend. Then immediately we see the crossing right here upwards above the level 67, or a junction where they meet the moving average of oscillator and the stochastic oscillator. When it touches or meets the black trend of the stochastic oscillator, you exit and you wait for an upper trend to start before you take another buy. Okay, you take another buy. All right, so and when you see a meeting at the top right here, know that a spike is going to come. So guys, if you've gotten like 10 candle ticks from the market successfully, that's a great amount of profit considering the amount of lot size you are using, right? Let's say you are using a lot size of 1 and you got 10 candle ticks from the market successfully. So remember, what we're doing is to make profit and avoiding the spikes, right? We're counting more of our profits than our losses on this trade. Okay, that's why I make and implement strategies for you guys so that you can make profit as well. Okay, so and if you're a beginner trader, you can make profit with this type of strategy. You can see how this strategy is really great and accurate in avoiding spikes and knowing when spikes will come, and you know, a full confidence that you can take few candle ticks from the market successfully. Then if you want to increase the accuracy and you want more accuracy in this type of strategy, what you do is to implement the MACD. Okay, you can add the MACD to these indicators as well. That's if you know how to trade properly using the MACD as well, right? So if you add the MACD together with this indicator, you will have even more accuracy on this type of strategy. Okay, you know, the MACD also help in catching spikes, and this strategy also help you see when spikes will come, although it won't tell you the appropriate time the spike is going to come, but you can tell and predict when the spike would come, when the stochastic oscillator is at the overbought level, and when the red and the black line has crossed above each other, the line will break down and a spike would occur at that point. Okay, so when it has crossed above the two lines and you wait after 2 candlesticks, then the spike would come, right? You can also exit immediately when you see a crossing of the red and the black line of the stochastic oscillator as well. Okay, so you can see how the strategy works. So what I'm going to do is to add the MACD just to show you guys how this is also good with using the MACD to these indicators to trade with this strategy. Okay, so what I'm going to do is to add the MACD. Right now, take a look at it. This is the MACD. Okay, let me add this pointer right here. This is the MACD. These black lines are the MACD. Okay, you can see that the MACD, when it has crossed above this level of 80 right here, a spike happened. Okay, a spike happened. Like you can see how accurate these 3 indicators are working together. Take a look at this, guys. This is the stochastic oscillator, right? This is the black line and this is the red line. Okay, and these blue lines, is the moving average of oscillator, which we are using to take our candlesticks, right? We're using it to take our candlesticks, and this is the stochastic oscillator. Now you see right here, when they crossed each other at this point, is the overbought. A spike would occur soon, right? But you see that immediately the MACD gave a signal that it has crossed the level of 80. A spike happened immediately, right? So you can also add the MACD together with this strategy. That's if you know how to use the MACD, right? There are other videos I have on my channel which I talk about the MACD, and I give tutorials on how you can use the MACD to trade. So you should check those videos as well if you want to learn how to use the MACD to trade boom and crash index successfully. But right now I'm showing you guys the stochastic oscillator and the moving averages of oscillator. Okay, so I'm just telling you guys that you can also add the MACD together with this strategy to trade it perfectly and get even more accuracy with this type of strategy, right? So what I'm going to do is to go to the boom 500 index and show you guys that this strategy works perfectly, right? So what I'm going to do is to remove the MACD, since we are not using it with this strategy, but you can use it if you know how to use the MACD, right? So I'm just showing you guys the basics of how it works. So I believe most of you guys already know how the MACD works if you have been watching most of my video tutorials, right? So what I'm going to do is to remove the MACD and go back right here. So guys, remember that there's no 100% strategy. Sometimes the market don't always want to go the way we want it to go, right? It don't always work that way. That's why we try to implement strategies to trade the market, such as crash and boom. Okay, so I'm going to show you a scenario that I'm talking about, that the market won't go the way we want it to go. You see, at this point right here, let me mark it for you guys so that you can see what I'm talking about. Right here at this point, okay, if you take a look at it right there, at this point you see that there's a lot of spikes. Okay, there's a lot of spike here to this point. What do you do in a position like this? Take a look. Remember I said that you wait after the spike, then you place a buy, right? And when you see a black line, when the blue moving average of oscillator touches the black line, or when it's about to touch the black line, you exit, right? That's what I said, right? Now take a look at it. After the spike right here, this is the spike. If you trace it up, this is the spike. If we zoom in, let's zoom and see how big the spike is right here. This is the spike. Okay, although the spike is not too big, right? But a spike is always a spike, right? So we wait after the spike before we place a buy, and we can see right here there's another red candle. Okay, a very little spike, but it's not a big one, right? And here again another spike. So you see what I'm talking about. Sometimes the market won't go the way we want it to go, right? But you can see that the spike is very little. If we zoom in again, you can see that the spike is very little. Okay, So you shouldn't feel afraid on the market like this. So what you should just do is to follow the procedure, follow your strategy, the strategy that you have planned to use on that trade. Follow that same strategy, right? There's going to be some losses on the trade. There's no trade that you enter that there won't be losses. There's going to be losses, but with the strategy that you have planned to use, you're going to see more profits than your losses. You're going to count more losses than your profits, right? There's going to be a loss on the trade, right? But if you use the right strategy, the right psychology, the right mindset, the right technical analysis, you're going to be at a profit. Okay, you're going to be at a profit. So as you can see right here at this point, there's a spike. So remember, the spike is going to be inside the stochastic oscillator, right? The moving averages right here. So immediately the spike, you place a buy, then you wait. After you see a black line of the stochastic oscillator, when the blue line of the moving averages crosses or touches, or when it's about to touch, you exit, because a spike, take a look at this, is a very big spike right here. Then you wait after the spike, then when it's an uptrend, okay, an uptrend, you place a buy. Okay, then when this black line and this red line crosses above at the top right here, you wait after a few candlesticks before you exit, because a spike is gonna come. Okay, the spike is gonna come after that. Take a look right here. You see, this is a spike. Immediately it curves down, it gave a spike at this point. Okay, then remember what I said, that this red line, which is the level 67, the moving averages of oscillator, the upwards and the downwards, has to be at the middle. Okay, it has to be at the middle. It has to be what separates the up and the down. Okay, it has to be what separates the up and the down, right? So this is the strategy for crash 500 index. Okay, for crash 500 index. Now I'm going to show you how you can use the same strategy to make profits if you are a boom trader, if you are trading on boom as well. So I'm going to show you how you can do that. I'm going to go over to boom 500 index right here. Boom 500 index is going to be from the upwards. Remember, we're taking a buy from downwards on crash, so we're going to take a buy from the upwards on boom on the moving averages of oscillator. Okay, you can see right here that this black and this red are the stochastic, and this middle one right here, this blue, is the moving average of oscillator, and this is a spike, right? Now take a look at it. After the spike, remember, like I said, the moving averages has to be in between the stochastic oscillator. It has to be in the stochastic oscillator, and you need to wait after the spike before you place a sell. Okay, on boom it is a sell, and on crash is a buy, because on boom we're taking the candlesticks, we're trading the candlesticks, we're not trading the spikes, right? So we're taking a sell. So you place a sell after the spike inside the stochastic oscillator, right? The moving averages of oscillator is the blue line. The stochastic oscillator is the black and the red lines, right? So after the spike, you place a sell. You place a sell, then you exit when the moving average of oscillator has touched this black line of the stochastic oscillator. Then you wait and you place another sell after it has crossed. Okay, then you place another sell after it has crossed. You place another sell, then you exit when you see a closing of the moving average of oscillator and the stochastic oscillator. When you see a closing, take a look at this closing. You see that the next line right here, it touched the black line, and there was a spike immediately. There was a spike immediately after touching the black line of the stochastic oscillator. The next line was a spike. Okay, then you wait again until you see a downtrend. You wait after the spike. This is a spike, right? And you see right here immediately a closing. Look at it, it almost touched the black line when there's a spike. Okay, it almost touched when there is a spike. See, so we're taking from the upwards to the downward trends, then we exit, then we wait again until the upward trends, right? Take a look at this point also. At this point, Take a look at it right here. We're taking from the upward trend, not the downwards. We're taking from the upwards. We'll take a sell immediately after the spike at the upwards. Okay, that's why I said you need to put this level of 67. It has to separate the two upward trends. This is an upward trend, this is a downward trend. Okay, let's zoom out. We're going to zoom out, so I'm going to zoom in. 1, 2, 3 and 4. Okay, then we're going to scroll until it has been in the middle of the level of 67. Okay, let's zoom in. Or if it did not enter the level of 67, what you have to do is to go to the indicators, right? You go to the indicators, you choose on the stochastic oscillator. Then you choose on the stochastic oscillator, you go to the levels, right? And when you go to the levels, what you need to do is to use this pointer right here and identify the middle line that separates the two. Okay, we're seeing 40.65. so what we'll do is to go to the indicator, the stochastic oscillator, and we'll put on 40 at the level of 67 right here. We'll put 40.65. we'll click on done. Okay, now as you can see, there's a black line. Take a look at it that separates the upwards moving average of oscillator and the downwards moving average of oscillator. So on boom it has to be 40.65 and on crash is 67. Okay, on crash is 67 right here. So I'm doing this, guys, so that you can know the upwards and the downward trends of the moving averages of oscillator, right? So remember, we're taking from an uptrend immediately, right? Take a look at this point right here. It wasn't inside before the spike occurred. Take a look. If you trace it upwards to the down, you can see that it was at the outside of the stochastic oscillator. It was outside the red line. It was outside the red line when the spike occurred at this point. So inside, after the spike, you place a sell. Then you exit when it has crossed the black line. You take your profit, then you place a sell again. Take the candle ticks. Then immediately you see a closing. Take a look at the closing. Take a look right here. You can see a very closing at this point. Then you exit immediately. When it's about to touch this line. You exit. You take your profit. Okay, that's when you know a spike is going to occur. Normally a spike would occur sooner at a point of the oversold, when the black line and the red line meet each other. When they meet, okay, there's a crossing right here. When there's a crossing, a spike would occur. It won't take long. So that's the point. You should know that a spike would occur, and you should take just 2 candle or 3 candle ticks before you exit. Okay, before you exit, then you wait again for an uptrend. Okay, an uptrend after the spike. Take a look at this. Trace it down after the spike. You place a sell. Then you exit when it had touched this black line. Okay, now you see the reason why I said wait until it touches the black line before you exit, because a spike would occur. Take a look at it. A spike would occur. So when you wait again, when there's no spike, then that's when you place another buy. That's when you place another sell. Okay, another sell. You see, it didn't create a downtrend at this point. So we exit at this point. Then the next step was a spike. Then before it created another uptrend again after the spike, you can see, but there was no spike inside. Take a look at it. It was at the crossing. You place a sell, then you exit when it has touched this black line, like it did at this point. Okay, take a look. This is an uptrend. This is also an uptrend. If you place a sell right here, you exit. Place a sell. Okay, you exit, then you place a sell after the line. because you don't know if it's going to create an upwards or a downwards. That's why you need to exit and you wait. Okay, you wait to analyze if it's going to create another upwards or a downwards. If it's a downward, that's when you place another sell. Then you exit immediately when it's about to touch this black line. Okay, so this is the simple strategy that I use to make profits on crash and boom. Okay, this strategy is so accurate, and if you add the MACD to this strategy, you will get even more better accuracy to trade crash and boom successfully and make profit. You can grow your small account into a big account, right? So I hope you understand what I've just shared to you guys. All right, so for the setup, remember we're using the same setup for crash and boom, right? Crash 500 and boom 500 index. So what we're going to do is we go to the indicator section right here. Now we're using two indicators, right? But I said if you know how to use the MACD perfectly, you can add it to the stochastic oscillator and the moving averages of oscillator to get more and better accuracy, right? So first and foremost, let me show you guys the stochastic oscillator setup, right? Now you choose on indicator window 1. You want to put the stochastic oscillator first before the moving averages, right? So when you put the stochastic oscillator first, you're going to set the period to 5. Then the second period should be on 3 and the slowing should be on 3 as well, while the price field is going to be low and high. The method should be on exponential, right? Now remember that we removed the level of 67 on crash 500 index, right, of the stochastic oscillator. Now the reason why I did this was on boom 500 index because it didn't level. Remember I said that you need to use the level of the 40.65 to separate this to moving average of oscillator at the upwards and the downward trends, the uptrends and the downtrends, right? So on the levels, what you do is to add the first level on 22, the second one is going to be on 80, right? And the third one is going to be 67 for crash 500 index. Let me remove it. Okay, put it on 67 right here for crash 500 index only, right? For crash 500 index. Then the style is going to be on 4 pixel while the color should be on black. Then you can use the middle line right here, which is this one that have space, right? Then after that you click on done, right? Then the main style right here is going to be on 3 pixel, the color is going to be on black, while the straight line pattern is right here, the one on the first one. Then the signal is going to be on 2 pixel, the color is going to be on red, and the line right here is going to be on the first one as well. Then you click on done. Okay, now we can clearly see the level of 67 which I talked about, that is going to separate the two lines, which is the upward trends of the moving average of oscillator and the downward trends of the moving average of oscillator, and we're using level 4. Okay, now I'm going to show you the setup for the moving average of oscillator. Remember the setup which we just set is for stochastic oscillator. The 3 levels 1, 2 and 3 is for stochastic oscillator, which is the black and red line. Now for the setup for the moving average of oscillator, we're going to put it on fast EMA is going to be on 12, slow EMA 26, then the MACD SMA is going to be on 9 while you apply it to close, right? Then you shouldn't add any levels because we have added levels on the stochastic oscillator, right? So what we're going to do now is to add the style, which is going to be on 2 pixel, while the color should be on blue, but you can use any color of your choice as long as you know what you are doing on the market. You're going to choose on blue right there. Then that's pretty much it. You click on done, right? You click on done. So this is the indicators we're using. You use the stochastic oscillator and the moving average of oscillator, right? And we're doing this on the 1 minute time frame, right? So we can go to a higher time frame on the 1 minute time frame. Okay, then for the MACD, just in case you want to add the MACD and you don't know the setup to use, let me show you guys the setup to use for the MACD as well. So the MACD, fast EMA is going to be on 12, slow EMA 26, MACD SMA is going to be on 9, right? Then while you apply to close, the main right here is going to be on 2 pixel, the color is going to be on black, color, then go back again, then the signal is going to be on 2 pixel with color red. Okay, the color is going to be on red, but you can use any color of your choice as long as you know what you're doing on the market, right? Then you should use the straight line pattern, which is going to be the one or the first one right here. Then that's pretty much it. You click on done, it's going to add into the chart, just as you can see right here. So I'm going to remove it quick. Okay, like I said, you should only know how to use the MACD. So when you know how to use MACD, that's when you can add it to the chart so that you can know the exact moment when the spike is going to appear, right? But remember, we're using the moving average of oscillator to take our candlesticks. Alright guys, so I believe after watching this video, you now understand how to use this strategy perfectly to grow your account and make profit. Alright, so if you find value in this video and you really enjoyed watching this video, then do it to like and subscribe to this channel, the Daily Forex. I will see you guys on the next video. Peace.